Hey everyone, Dave Keller here with StockCharts.com. Welcome to a special edition of the Final Bar. Wanted to share with you what I call Trend Following 101. I often talk on the Final Bar and elsewhere on StockCharts TV and in my written material on StockCharts.com about the importance of trend following, really momentum-based investing. And the general technical toolkit that I'm portraying and the set of tools that I use are a trend following toolkit. It's really designed to help you understand how things are evolving over time and to focus on leaning into what's working and leaning away from what's not working. But to be honest with you, these are tools that institutional investors have used for decades and decades, if not more. And the most institutional technical analysts use a trend following toolkit. You're working with longer term investors, and your goal is to track trends and follow those trends as well as you can. And it's based on for lack of a better word, it's based on academic support for that approach. If you Google momentum investing or the momentum factor in particular, you will find a lot of academic research that validates momentum-based investing, which is essentially owning what's working and not owning or underweighting the things that are not working based on some historical look back period. And in general, people tend to look the data. If you tend to look 6 to 12 months back, that's in general what I've seen. You look at 6-month returns or 12-month returns or some weighted version of multiple time frame returns. And the idea is if you rank stocks based on their return profiles and own the strongest names with that look back period and do not own the weakest names, in general, you're going to tend to do pretty well. And that is the essence of momentum-based investing, what we'll call trend following. So what does it actually represent? How do we quantify trends? How do we follow them? And how do we look for opportunities? That's what we're going to talk about today. So we're going to get to this chart of the S&P 500 in a little while. But first, I wanted to start with 3 slides that I think tell the story of trend following. We're going to go back a little bit. This is looking at the semiconductor ETF, ticker SMH. And we're starting in July of 2020. Now, if you remember through your market history in 2020, we rallied in the fourth quarter of 2019, continued to make higher highs in January, and then in February 2020. And the broader market did something kind of like this. This is semiconductors in particular that we're looking at. Then we obviously had that significant drawdown in March when we dropped down to just below 100 for the SMH. From there, we rotated back higher. Now look at what happened here. After that corrective move, and after we recovered all the way back, found resistance here, pulled back, and then broke to new highs. So the idea with trend following was we want to look for stocks and ETFs in a position of strength. We want to look for stocks that have had good returns over some previous look back period. So how do you do that? Well, institutional investors, quantitative investors, or quantitative analysts will basically rank stocks. They will basically bring in the 1-year returns or 3-month returns or whatever it is they want to do. And they will literally rank stocks from 1 to 1,000 or whatever the universe is. And then, own the, highest decile, lowest decile, right? The top ranked names within this basket of stocks. But from a technical perspective, it's all about quantifying the trend. It's all about determining whether the trend is positive or negative. And Charles Dow, over 100 years ago, gave us a classic way to do that. It's basically look at the high prices and the low prices. So an uptrend is a pattern of higher highs and higher lows. A downtrend is a pattern of lower lows and lower highs. So as long as you can pick out the high and low prices, the peaks and the valleys in the price, and track whether or not they're going higher or lower, you have the answer as to whether or not we're in an uptrend. So at this point, looking at semiconductors in July of 2020, what's the trend? Visually, pretty clear that it's higher, right? But we can validate that by saying the high prices are getting higher. The low prices are getting higher as well. Now, there are other ways we can measure this as well, right? The price is above 2 upward sloping moving averages. That tells you that in the short term, we're trading stronger than we have been over the long term. That's encouraging as well. The relative strength at the very bottom, this is looking at semiconductors relative to the S&P 500, that's sloping higher, which means in general, not only are semiconductors going higher, they're actually outperforming a passive benchmark, right? Outperforming the S&P. So at this point, chart looks pretty strong. And the idea with trend following is we should not be afraid to buy new highs, right? The fact that semiconductors are making a new multi-year high here should not be a bad thing. And I think a lot of times, individual investors see something breaking out and they think, oh no, I missed it, right? I wish I would have bought it at the lows. That's great. And there's a whole separate discipline, more value oriented, more contrarian, where you're actually buying price lows. But this toolkit we're talking about is more momentum based. We're actually waiting for when the trend turns higher. Now, I should note earlier in the trend, were there signs that the trend was reversing to the upside? Absolutely, right? And I know when the market sold off into March and then made a higher low in early April, that was probably the first indication that things were starting to improve. When we made a higher low and then made a new swing high in early April, that's even more confirmational. When we break back above the 200-day moving average after spending about a month below the 200-day, that's a thumbs up as well. So one by one, we sort of fulfill these requirements that confirm more and more the fact that semiconductors are in an uptrend. So how you actually scale into this sort of position is really up to you. That's really depends on how aggressive or how conservative of a trading strategy you're trying to follow. So let's say you're being incredibly conservative. You're just waiting until you are 100% validated that the trend is positive. Arguably at this point, anyone following trends is going to recognize the trend is positive. So step one, I think you have to do three things. Number one, identify trends. And those are some of the ways that I would try to do it. Now, the second step, and an important one, is to follow those trends. As humans, we tend to sell early, and that is what often leads to leaving some of the best opportunities on the table, right? Buying a stock and it goes up 10% is great. Buying a stock and it goes up 1,000% is a lot better. And a lot of times when something goes up 10%, we want to recognize those gains and lock them in, and we don't want to recognize our losses. And what happens is we end up cutting our winners short, and we end up riding our losers down. And if you consistently sell your winners in your portfolio and don't sell your losers, your portfolio is getting worse and worse. That is a way to underperform consistently. What you want to do is, some of the phrases you might have heard traders say before, you want to let your winners run, you want to cut your losses short, those sorts of things, right? So when things are underperforming, you want to cut those off and limit your downside losses. Things that are working, you want to keep riding those trends. And that's what step two is all about, following the trends higher. So we've now fast forwarded the chart about 6 months. We can see the previous slide was back here when we were making new highs. We've now continued higher. You can see the prices continue to make higher highs and higher lows. Prices pulled back to the 50-day moving average a couple of times, but each time has bounced right back off of it. So overall, this is confirming the fact that we're in a good uptrend. The relative strength continues to go higher, meaning it's not only is the price going up, but you're doing better than just owning the S&P 500 and sitting in a passive benchmark. So the goal is to continue to follow trends like that until the chart tells you the trend is no longer positive. And that's just going to get us to step three, which is to have a toolkit that helps you anticipate when those trends are exhausted. So once we identify trends, once we follow those trends, the third piece is to make sure we recognize when the trend is no longer up. So having some regular routine to review and reflect on how your positions are performing, and recognizing when some of the stocks that your ETFs that you might be holding are no longer going higher. So let's look at what happened with the semiconductor ETF. We're now fast forwarding a little bit further, and now we can see that the prices continue to go higher and higher. This is now early 2021, and you can see that the price made new highs January into February, but look at the RSI, a measure of momentum. This is called a bearish momentum divergence, where the price goes higher and the RSI slopes downwards. Overbought on that first new high, not overbought or right at the overbought level on the second new high. So that situation where the price goes higher but on weaker momentum is a sign of internal weakness. That tells you that the buying power is starting to lighten up. It tells you that there is less upside momentum, less force behind the move to higher prices, and often is an indication of the end of a bull market phase, not early on in the bull market phase. Soon after, if you know what happened, as these things sorted chopped around, this is when some of the cyclical sectors really started to perform well in the first into the second quarter, and semiconductors started to outperform pretty poorly. So the idea here is that three-step process. Step one, identify trends. Step two, follow those trends. Step three, anticipate when those trends are exhausted. And these three charts using the SMH in 2020 and 2021, I think illustrate those three pieces pretty well. So how do we actually apply that to more current environments? And I'm recording this in mid-February of 2022. Here we're looking at a daily chart of the S&P, and I want to show you if we apply that mentality, think about those three steps, identifying the trends, following the trends, and anticipating when they're exhausted. What can we tell from the evidence on the chart? Now, I have a bunch of lines on here, and I often tell people with something like the S&P 500, treat your charts not as a painting, something you would print out and hang on the wall. Think of it as a workbook, right? As an active document For me, at least, it's an active document, particularly this daily chart of the S&P. This is where I'm always trying to just track key levels, key patterns, key indications that I think are important to pay attention to. So it's a little busy with all these notations, but look at the black open, high, low, close bars. That gives you the overall chart for the last 1 year. So the first 2/3 of this chart, look at how this is obviously in a fairly consistent uptrend, right? Higher highs, higher lows. This is remaining above the 50-day moving average for the most part. Notable exceptions, September and October of 2021, but for the most part, remained above the 50-day moving average and just continue to make higher highs. So overall, that's a position of strength. Now you'll notice some of these bearish momentum divergences that I identified on the chart. And what was so interesting about 2021 is you had a number of these bearish momentum divergences, but the price really didn't come off too much on the S&P 500. Right? The market pulled back a bit, right, 3 to 5% mostly on average, but those are not huge drawdowns relative to what you'd normally expect. Overall, this is a stock that's or a chart that's actually shrugging off those signs of potential trend weakness, of trend exhaustion, and continuing to make new highs. So overall, it's been strong. Look at how that changed, though, in the fourth quarter of last year, right? We made new highs November, December, January. You have momentum sloping downwards, right? So every time the S&P is trying to make new highs and even successfully making new highs, there's less and less upside momentum behind those upward movements. That is that third piece, identifying trend exhaustion. This is why going into year end, seasonally makes a lot of sense for stocks to do well, and the market overall did just fine, making new highs around 4,800. But the fact that there were momentum divergences underneath the hood, weakening momentum characteristics tells me we're more at the later stages than at the early stages. Now, having said that, I'd seen a lot of these bearish momentum divergences before, so my thought was, we need to wait for some sort of confirmation. Instead of making higher lows, we make lower lows. Instead of making higher highs, we make lower highs. Look at what's happened so far in 2022. We've done all those things. Instead of making a higher high into early January, we've now established arguably a lower high in early February. Instead of going to higher lows, as we did for much of last year, we've made a lower low, right? We've undercut the December low significantly, right? With a valid breakdown of a previously identified support level. And this pink shaded area, by the way, is around 45.50. We've talked on the show a lot about how resistance became support and broke down. On my own YouTube channel called Market Misbehavior, I recorded a video a couple of weeks ago about polarity, which is this concept of resistance becoming support. So if that doesn't make sense, check out that video to explain that concept and why 45.50 was such an important level. I think remains an important level to watch here in mid to late February and arguably beyond. Now, this is another time or another piece of evidence I'd want to illustrate is the momentum characteristic. So we talked about trend exhaustion and how momentums can start to slope downwards, right? So you have higher prices on lower momentum, what's called the momentum divergence. You can also look at the range of the RSI and just where it is. In a bull market phase, when prices are going higher, like you see in the first half of this chart, note how when the S&P is making new highs, it often becomes overbought, right? Overbought means up a lot. That means the price is going up on strong momentum. That's good if you're bullish. When the price pulls back, notice how the RSI rarely got below 40. In a bull market phase, when things are going well, you tend to become overbought on the upswings, and you rarely get below 40 because the entire range of the RSI actually goes up. In a downtrend, in a bearish phase, the entire range actually often comes down a bit. So instead of becoming overbought, you don't make it to the overbought region when the price rallies. When the market sells off, you tend to become oversold because there's an influx of sellers. There's a increase in selling pressure that causes momentum to go lower. So look at how the RSI has gone from a bullish phase here in the first 2/3 of the chart to more of a bearish phase. Now, when the price is trying to make new highs or making swings higher, the RSI remains below 60. When the price sells off, it becomes oversold. So on the chart of the S&P, when I talk about how the market has changed, how 2022 looks very different than what we saw in 2021, and why I don't subscribe to this is just another buyable dip thesis, it's because of this, because the momentum characteristics have changed. It looked a particular way through much of 2021, which is a buy on the dips, bull market phase, higher highs, higher lows, finding support at the 50-day, the RSI finding support at 40. All of that's out the door now. We're now doing a very different phase. We're making lower highs, lower lows. The RSI more in a bearish phase. We're failing to hold support levels. So I think there's likely that we see I don't know if the lows are in yet for this corrective move. I would argue they're most likely not, given this deterioration that we've talked about so far. Let's look at a couple more examples here. Disney is a good example I was looking at recently. And again, when you think about a chart that has transitioned from a bullish phase to a bearish phase, just look at the left half of this chart, which is much of 2020 into early 2021. From the first quarter, really the second quarter of 2021 on, look at how Disney has rotated from a bullish phase to a bearish phase. Now, how do we determine that? Well, a bullish phase is higher highs and higher lows. This is when ideally you'd want to own a stock like Disney, as it's able to continue to make new highs. Then all of a sudden that changes. Instead of making higher highs, we're making lower highs. Instead of eclipsing previous resistance, we're unable to break above resistance. I would say for Disney, its inability to get above sort of this 185 level, which was resistance in April and May of last year, then resistance again, July, August, September, we then break down. We make a new resistance level and we don't get above there. We went from going up, from remaining above the 200-day moving average to below the 200-day moving average and failing to get back above it on a number of attempts. Now we've made a pattern of lower lows and lower highs. That's why I would argue this chart right now is a crucial one as a trend follower, because I've been talking about the downtrend in Disney for quite some time. Recognize the fact that we stopped making new highs, a breakdown of the 50-day, breakdown of the 200-day, breakdown of support after failing to eclipse previous resistance. All of this from my trend following methodology indicated market going lower. And you can see Disney certainly gapped lower and then followed through to the downside since then. But now all of a sudden, we're maybe seeing signs of improvement. We're coming off of a lower low, which is probably one of the things why, one of the reasons why I think there's still a good amount to prove on this chart. But now we're starting to rotate higher. We're back above the 50-day moving average. So what would we need to see as a trend follower to indicate a rotation from downtrend to uptrend? So think about the example we talked about earlier, looking at semiconductors in an uptrend. And look for those pieces of evidence, right? Here we have a pattern of lower lows and lower highs. So we would need to change that pattern. We would need to see a higher low. We would need to see Disney pull back and not break below 130 to 135, right? Where we found support here. It's one of the reasons why this continued to look negative was instead of holding support around 140, 145, we broke below that, right? So making a higher low would be one big thumbs up or one indication of more of a rotation to what I'd call an accumulation phase. We need to make a higher high, right? So most recent high is here at 160. We need to get above 160 and stay there, right? We need to indicate that we are able to eclipse previous resistance. And again, think behaviorally about what that means. There are a bunch of people here that bought this stock that are all underwater. Anyone that bought it after this gap down is currently sitting on a paper loss at the very least. Until price gets above 160. When we get above 160, everyone that bought back here is now in the black. We're all in the having registering a positive return for that trade. That's why resistance tends to be so important. And that's why breaking through resistance can be such a pivotal moment from a technical perspective, looking at a chart like this. So higher low, number one, getting above 160, getting above previous resistance. Number two, getting above the 200-day moving average. That would be another one. The relative strength improving from being in a downtrend to starting to be in an uptrend. The RSI getting above 60. And that's why I think this is such an important chart to watch in the coming weeks. We are right there. We are literally right at that point. I've had a number of times after the uptrend was over and we went down, look at how the whole range of the RSI kind of comes off a little bit. We have rarely gotten above 60 and we've often become oversold. That needs to change. So you need to actually get above 60 and ideally the RSI becomes overbought, which indicates enough buyers are coming in to really change the characteristics of this chart. So I think Disney is a really good example right now. Number one, of a chart that rotated from what I'd call an accumulation phase, an uptrend, to a distribution phase, a downtrend. Arguably, there's this consolidation phase, a sideways trend in the middle here. So you have accumulation, consolidation, distribution. And now what tells us or would tell us that the distribution phase is over, those things we talked about: higher low, higher high, get above the 200-day, RSI gets above 60, relative strength improves. That's what you would look for improvement on that chart. You can see now, thinking of the chart of Disney in the back of your head, look at the chart of the ARK Innovation Fund, ARKK, and you can see why it is, again, just like with Disney, rotated from an accumulation phase in the left half of the chart to a distribution phase on the right half of the chart. Look at the RSI, how we often found support above 40. Now, all of a sudden, we're in a downtrend. We rarely get above 60, right? So the whole range has come off. Attempts to eclipse previous resistance have failed. And that's actually happened a number of times on ARK. And so when ARK has bounced higher and people start getting really excited about it, I always look to the left on the chart and think, all right, where are we at relative to where we've been? We need to eclipse those previous highs to validate the fact that this is a new uptrend. It hasn't happened. It really hasn't happened since February of 2021. That's the last new high that we saw here. From there on, the swing highs have been unable to eclipse previous resistance, and we've made new lows and lower highs, particularly in the last 4 or 5 months. So what would we need to see on the chart of ARK Innovation Fund? Well, similar to what we talked about with Disney, you want to see a higher high, you need to see a higher low. The RSI has remained below 50 for the last 10 to 12 weeks. You need to get above that and get above 60, which is where we found resistance a number of times. So we avoid, in general, as a trend follower, you avoid charts that are making new lows below 2 downward sloping moving averages. That's what ARKK is telling us right now. We want to look for charts that are starting to improve. By the way, I was going to say the other thing I wanted to point out was I did a webcast recently for the Money Show talking about cannabis stocks, and we looked at things like Tilray, CGC, which is Canopy Growth. And these are charts obviously in a clear distribution phase. These are stocks that have been making lower lows and lower highs for a long time. Many of them still below 2 downward sloping moving averages, but just bouncing in the last couple of weeks. And so the question is, at what point do you find that these sorts of charts are starting to show improvement? And those are individual names. You can also look at MJ or YOLO. These are the ETFs that sort of track this space as well. So looking at MJ, for example, what would you need to see? Well, for me, similar to the previous charts we've talked about, right? You want to see this transition from a distribution phase, which I would argue we're still in, to an accumulation phase. The way you can tell that we've rotated is you make a higher high, you make a higher low. Instead of being below moving averages, you get above the moving averages. Instead of the RSI being in a bearish phase, and look at how long this has been in a bearish phase. It's been a bullish phase the fourth quarter of 2020 and first quarter of 2021, as the RSI remained above 40, as the price became overbought. From then on, this has been a chart in a bearish phase, lower highs all along the way, the RSI never really getting above 60. So you would need to see that happen. So while the bounce from 9 and change to 11 is an impressive bounce, that's a big percent change off of something that's had such a move lower. Totally granted, but it's not enough for me as a trend follower to confirm the fact that we've rotated from a bearish distribution phase to an accumulation phase. I would want to see things like a higher low. At some point, we get another pullback. Do we remain above the previous lows? We stop making lower lows. Then do we make a new high, right? Can we get above previous resistance levels? On MJ, for example, you have pretty good resistance here in sort of the 11 to 1150 range. You need to get above there and indicate that not just buyers are buying on the dips, but that there's enough buying power that is going to potentially propel the price higher. I think the RSI on a chart like this is super important. Look at how every one of these big moves higher, when you could have been drawn in, sucked into these bear market rallies, the RSI never got above 60. You'd need to see that happen. You need to see an indication of an influx of buyers. Compare that chart to something like, a seed company, or any of these materials names like, Mosaic, ADM, and you can see what a chart looks like when it's more of a bullish phase, right? Making higher highs above 2 upward sloping moving averages, RSI tending to find support at or above 40. So you want to see that rotation, and you're not seeing it yet on some of these names. This is why, even though the market has been super volatile, a lot of names have been beaten down. I don't see enough improvement in a lot of those as a trend follower to compel me to think about getting back into those charts. But those are some of the steps that I would look for. Just to finish off this special presentation, Trend Following 101, how do we look for stocks that are actually in improving trends, right? I've shown you some curated examples, some handpicked examples of charts in uptrends, charts in downtrends, and things that I think have rotated from one phase to the other. How do we look for ideas? Well, a common scan that I run is looking for stocks making new 13-week highs or 3-month highs. I do, on the other side, I look for stocks making new 3-month lows all the time. Started doing this years and years ago because I first started looking for 52-week highs and lows, and that's a decent group of names to look at as well, of course. But a lot of times, if you're making a new 12-month high, you've already had a really good run, and by the time it comes up on that screen, a lot of times the biggest gains may have already happened. Arguably, that those stocks can continue to improve, but a lot of times you're getting in well after the trend has emerged. What if you're looking for things that are more rotating, right? Things like Tilray, which if and when they stop going down and start going higher and really follow through, eventually they will make a close that is higher than the last 3 months closes, and then it would appear on this screen that I look at. I just ran the screen earlier today, came up with 113 stocks, and I'm looking for US names, not ETFs, with a market cap above 10 billion is sort of a general, fairly liquid group of mid cap and higher, larger stocks. And this week, just today, I came up with 113 names that did it. I run this scan all the time, and I look for, again, I look for new 3-month highs and I look for new 3-month lows. Then what I basically do is dump those into a chart list and start going through a bunch of the individual charts. So here I brought up that list. I put them into a chart list, and I'm on the second page. I was flicking through this before we started this, and Baidu is a really good example that came up here. I would argue Baidu is maybe a little early on, but it's potentially right at that point where it's making that transition. And again, depending on how aggressive you want to be, depending on what your risk appetite is, you could look at names that are early on and have the strong potential of rotating. And if they don't rotate, you manage your risk and you have stops in place to make sure you minimize the downside risk. But overall, you have the potential to getting in much early on a rotation higher. So look at how Baidu has been in a downtrend of lower highs and lower lows. You've had a number of attempts for Baidu to make new swing highs. It's often failed, never really followed through. And it started to stabilize now, right? And if you look back in August of last year, we had a bottom around 135 here in December. And then late December, you bottomed out around that same level, only got down to around 140. So sort of this 135 to 140 range has served as support a number of times. We're now at the upper end of that range and just potentially making a new swing high. And it's making a new 3-month closing high because we're right back at those levels. We've arguably made a higher low when we put in a low here at 140, and the previous low they were down here, right, around 132 and around 135. So lows are getting higher. Highs are potentially getting higher. We're right at the 200-day moving average. So this is very close to starting to rotate higher. What's good about charts like this is that your risk reward is much more ideal. When you buy stocks at new highs, think of like energy stocks right now, you're buying things that have already had a pretty good move higher. So you're limited in terms of the upside potential, but big downside risk to test those previous lows. Here, you have limited downside risk, right? If you have a stop at the lows there, but you have a chance to return at the very least, making up or regaining some of those, that down move that you saw in 2021. So that is a special trend following 101. We talked about how to identify trends, how to follow those trends, and how to anticipate when they're done, and to focus on scanning for new ideas by looking for 3-month highs and 3-month lows. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good one.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.